Stocks jumped 300 points as the Federal Reserve decided to keep interest rates steady. So in this video here, we're going to look at the video that Jerome Powell did, and we're going to discuss what does that mean for investors, and we're going to do a walkthrough as well. But ladies and gentlemen, if you haven't done so already, go ahead and hit the subscribe button, hit the bell icon, hit that like, comment, and share button. So, ladies and gentlemen, we are going to tune in. The Federal Reserve today, they announced that they're going to keep interest rates steady, which is not a big thing here. It's kind of what we expected. The stock market jumped up 100 points. Why this is a big deal? Interest rates have been at an all-time historic low. And you're looking at a picture here if you're catching this live. This is Jerome Powell. But if you guys and girls didn't know, I'm all the way live from the beautiful city and state of San Antonio, Texas. So for prime example, he's going to talk about inflation, the interest rates, unemployment, and GDP, the motor industry, the supply bottleneck, and how he looks at the particular economy. Very important for investors to know what the Federal Reserve is saying, because they're the ones that have control of monetary policies. And we all know monetary policies controlled by the Federal Reserve. They can start tapering, all of the good stuff like that. So as I play this, as he's speaking, I'm going to give you a breakdown of what he's saying. All right, so let's tune in. Let's listen.
Good afternoon. At the Federal Reserve, we are strongly committed to achieving the monetary policy goals that Congress has given us: maximum employment and price stability. Today, the Federal Open Market Committee kept interest rates near zero and maintained our current pace of asset purchases. These measures, along with our...
Now notice he said asset purchasing. So asset purchasing, pretty much AKA a form of quantitative easily pumping money into the stock market, all right?
Strong guidance on interest rates and on our balance sheet will ensure that monetary policy will continue to support the economy until the recovery is complete. Progress on vaccinations and unprecedented fiscal policy actions are also providing strong support to the recovery. Indicators of economic activity and employment have continued to strengthen. Real GDP rose at a robust 6.4% pace in the first half of the year, and growth is widely expected to continue at a strong pace in the second half. The sectors most adversely affected by the pandemic have improved in recent months, but the rise in COVID-19 cases has slowed their recovery. Household spending rose at an especially rapid pace over the first half of the year, but flattened out in July and August as spending softened in COVID-sensitive sectors, such as travel and restaurants.
So notice he said household spending increased in the beginning of the year, but started to slow. I believe comes from our stimulus packages, unemployment, things like that. And they started to taper off as people started to get back to work. That's my synopsis of that. And he's saying the industry that was hit the worst was travel and restaurants. So when you look at this, they're telling you that people that travel in restaurants, that's why you're seeing this stock start to slow down. But this is where, as an investor, you see you're buying opportunities in the companies that are having a struggling point right now. These are your airlines, restaurant stocks, and things of that nature. So right there is a key indicator for myself to say, hey, these are some sectors that I can look at as an investor where there could possibly be some opportunities. All right, here we go.
Additionally, in some industries, near-term supply constraints are restraining activity. These constraints are particularly acute in the motor vehicle industry, where the worldwide shortage of semiconductors has sharply curtailed production. Partly reflecting the effects of the virus and supply constraints, forecasts from FOMC participants for economic growth this year have been revised somewhat lower since our June summary of economic projections, but participants still foresee rapid growth. As with overall economic activity, conditions in the labor market have continued to improve. Demand for labor is very strong, and job gains averaged 750,000 per month over the past 3 months. In August, however, job gains slowed markedly, with the slowdown concentrated in sectors most sensitive to the pandemic, including leisure and hospitality. The employment rate was 5.2% in August, and this figure understates the shortfall in employment.
Now, here I want to pause real quick. He spoke about supply bottlenecks, and he spoke about the labor market shortage. Now, how these go hand in hand, these are, let's say, for prime example, the chip shortage. Let's say a manufacturer, let's say if you make curtains, if you can't get enough people to make curtains for your customers, then guess what? The supply still slows down, prices go up. This is what we're going to see curtailing to inflation. But he's going to pass this off. As you're going to see later on, he's going to say, hey, right now we just have a shortage of workers. Once that kind of gets back, inflation will kind of taper off. All right, let's follow him while he says it.
Particularly as participation in the labor market has not moved up from the low rates that have prevailed for most of the past year. Factors related to the pandemic, such as caregiving needs and ongoing fears of the virus, appear to be weighing on employment growth.
Umbrellas.
These factors should diminish with progress on containing the virus, leading to more rapid gains in employment. Looking ahead, FOMC participants.
Now he's saying that as we get rid of the COVID, then we're going to be stepping back into more people going to be becoming employed.
Participants project the labor market to continue to improve, with the median projection for the unemployment rate standing at 4.8% at the end of this year and 3.5% in 2023 and 24. The economic downturn has not fallen equally on all Americans, and those least able to shoulder the burden have been hardest hit. In particular, despite progress, joblessness continues to fall disproportionately on lower wage workers in the service sector and on African Americans and Hispanics. Inflation is elevated and will likely remain so in coming months before moderating. As the economy continues to reopen and spending rebounds, we are seeing upward pressure on prices, particularly because supply bottlenecks in some sectors have limited how quickly production can respond in the near term. These bottleneck effects have been larger and longer lasting than anticipated, leading to upward revisions to participants' inflation projections for this year.
So right there, what he said in the long term, he just said, imagine you are McDonald's and you sell hamburgers, right? And when you're looking to sell hamburgers, people come in, they buy your hamburgers, but let's say, like we seen this in chicken wings. Remember the chicken wing shortage? You've seen Wingstop go to thighs. They couldn't get enough chicken wings. So when the chicken wings, once you have a shortage, you start to raise the price of chicken wings. So he believes that, hey, once we get more people employed, once we get rid of the shortage, and we kind of return the supply back to normal, then those prices will normalize and drop. Pretty much. So he said we're seeing these high prices and inflation due to the supply bottleneck.
While these supply effects are prominent for now, they will abate. And as they do, inflation is expected to drop back toward our longer run goal. The median inflation projection from FOMC participants falls from 4.2% this year to 2.2% next year. The process of reopening the economy is unprecedented, as was the shutdown at the onset of the pandemic. As the reopening continues, bottlenecks, hiring difficulties, and other constraints could again prove to be greater and longer lasting than anticipated, posing upside risks to inflation. Our framework for monetary policy emphasizes the importance of having well-anchored inflation expectations, both to foster price stability and to enhance our ability to promote our broad-based and inclusive maximum employment goal. Indicators of longer-term inflation expectations appear broadly consistent with our longer-run inflation goal of 2%. If sustained higher inflation were to become a serious concern, we would certainly respond and use our tools to assure that inflation runs at levels that are consistent with our goal. The path of the economy continues to depend on the course of the virus, and risks to the economic outlook remain. The Delta variant has led to significant increases in COVID-19 cases, resulting in significant hardship and loss, and slowing the economic recovery. Continued progress on vaccinations would help contain the virus and support a return to more normal economic conditions. The Fed's policy actions have been guided by our mandate to promote maximum employment and stable prices for the American people, along with our responsibilities to promote the stability of the financial system.
Now, in a nutshell, when I look at this, all I pretty much heard him say was hey, we didn't touch interest rates. And looking at the Fed's projections, it's looking like they're not going to touch interest rates to 2023, right? So with interest rates being low, and I didn't see them mention anything about their asset purchasing, mean pumping money into the stock market, low interest rates, pumping money into the stock market, ride the bull. Right now, I've seen people jump in and say, oh, we got this going on in China, we got inflation, da da da. But from the Federal Reserve is saying, from their monetary standpoint, ride the bull. That's all I get from that. So, ladies and gentlemen, hopefully y'all guys and girls got something out of that. This is the Federal Reserve. Hopefully y'all, if y'all like me doing these reviews of the Federal Reserve when they speak, drop me a comment below and hit me a thumbs up. But I'm going to enjoy some time with the family while I'm down here in San Antonio, Texas. Until the next video, podcast, cartoon, or whatever else crazy y'all see me doing around the globe. Hold on, let me say this. Brawless occasion on Twitch. Shouts out to you. Thank you for tuning in live. But anyway, my name is Prince Dykes. This is the Investor Show. Peace, be safe. I'm out, and thank you.